Hi, this is James Zhang, and today I'm here with Zach Weik, and today we're going to be talking about Houston. And so Zach put together a few slides for us. And Zach, why don't you just kick it off, give us a little bit of your background, and let's jump into these slides on Houston.
Yeah, thanks, James. I came from the consulting advisory industry, and now I'm with a multifamily group here in Houston, out of the Houston office. And so I just wanted to provide kind of just a high level Houston market update of what I'm seeing and just the people I've been talking to, and provide that data and try to just share that perspective and get James' perspective and kind of just provide some information on that. So.
All right, let's get started. So on this first slide, you shared some employment numbers. So maybe jump into sort of how Houston compares to the national.
Yeah. So, I mean, I think in the last 8 to 10 years, we've seen, Houston being a hot market to come into, especially Texas. And so our main three cities have been Austin, Dallas, and Houston. And so Houston has done relatively well with employment growth. Our economy is based in oil and gas, but we've also diversified into other sectors. And so we've had a good run. And that's why we've seen a lot of development in Houston. And so, but when we think about the next 2 years of what's being forecasted by Yardi, Houston does relatively well, but our main two cities in Texas is Austin and Dallas. And so the developers that I've spoken to, they're not focusing much on Houston anymore, but Austin, Dallas, and Phoenix has actually been another one, a submarket. And so when we think about, future supply, Houston is no longer, in their perspective, number one city in Texas.
But it looks like employment growth looks like it's going to continue even, at a lower pace, I guess, is what this is saying to some extent. And so Austin, Dallas, and Houston are still going to fare better than a majority of the U.S., which is great.
Right.
And that's going to grow and help the sort of multifamily market. I guess talk about sort of historical collections, what we're seeing so far across the nation.
Yeah, so I think when COVID hit, we were all speculated on what was going to happen with collections. And so when we're looking at the rent payment tracker by month, if we look at June 2019 and June 2020, it's about 89%. And so when we think about what was the cause of that, it can be a few things. From my perspective, it's the stimulus check package that was put out to the economy. It was the additional $600 unemployment benefits. And I think tenants didn't want to move during these times. And so that's additional costs. And so the renewal rate is actually up for people. And so collections have been the same since last year, but we've gone through a pandemic. So it's going to be very interesting in future quarters what's going to happen with rent collection so far in multifamily. We've seen in retail how it has dropped, and banks are foregoing people's payments right now from the owners. But right now, owners in multifamily are still able to make them.
Yeah, and I mean, Fannie and Freddie have also sort of lessened their reserves in terms of the amount and how long they're holding them based off of these collection data. So they're seeing it in their portfolio. Obviously, nobody can predict the future, so we'll see how the rest of the year pans out. But as of now, the last 3 months have looked pretty good from the apartment standpoint in terms of collections. Let's jump in sort of Houston specifically. Give us some stats on Houston and sort of how it compares versus the national data.
Yeah, so I mean, when we think about kind of from the first slide of the job employment growth, why Houston is such a favorable city for multifamily, I think it's kind of twofold. I think it's if you think about median household income and what you can buy with it. So when we think about median price versus national, and I think we have a shortage in supply. When I read a book the other day that 73% of Gen X are going to be renters. And so we're not able to build the supply to meet market demand. So YE 2019, we're up 2%, but it's not able to meet the demand that's needed. And then when you look at asking rents, 1,100 versus national at 1,300. It's why Houston is a favorable city compared to others. And the percentage of rent of the median household, Houston is 20% versus national is 27%. So it just, your dollar can go far longer here in the Houston markets versus, your San Francisco's or your New York's and LA's and stuff like that.
Yeah, and I mean, we didn't show like a big map of Houston, but Houston's pretty freaking spread out, and so I think people are going to start not going for the density, and a lot of this sort of work from home that's we're seeing across companies. I think as people move out of California and New York, maybe these higher cost of living areas, they're going to start gravitating towards the South, and Houston's going to be one of those markets, and Houston is definitely more I guess demographically diverse across the whole. And so I'm originally from Houston, and so I definitely understand that the data is there that it is a cheaper place to live than a lot of these other areas across the nation. So let's keep going here. So let's talk about the economy in Houston.
Yeah, so I mean, if you look at populous cities, in the United States, New York at 19 million, Houston's at 7 million. Dallas surpassed us, and it was notable that we were going to pass Chicago, but it still hasn't happened. And so, out of the 7 million, 1.2 million residents occupy apartments, and so it's a big um, demand for market multifamily apartments. But what we think about is the job loss that's happened and due to COVID. So 330 jobs as a county metro Houston areas, and then one interesting thing also was Houston would need to lose an additional 90,000 jobs to match the 1 in 7 job loss ratio. Us because we have a more diversified economy. We're not putting all of our jobs in oil and gas. And so, when I started my career out of college, oil was at $100. Now it's at $37. And so, how are oil and gas companies that provide so much job growth are going to, run their business in a sub $50 barrel market? Are they have to reduce the capex spending? I mean, Shell came out reducing, capex spending. Halliburton's reducing capex spending, and so that's kind of the main thing I wanted to show is, our Houston economy is favorably oil and gas, but we have diversified that in the past, 10 years, 20 years.
So, are there any projections on? Do you think Houston is going to lag the national sort of unemployment, or you think we're going to be out in front of it? Like, how do you think is it going to recover faster than the national? Any forecast on that? I know that's a difficult question.
That's a difficult question. I don't know the answer to that, James, but I can't provide perspective on that. But what I have seen is, once capex stops, when oil and gas companies stop their capex spending, is when they do a lot of the layoffs. Okay. And so it's really going to matter on supply of what's going on overseas. Do they reduce their production to make it a more even playing field for everybody? And so yeah, I mean, that's my perspective on it. I don't know the answer to that. If I did, I would make some oil and gas hedge bets, but
what's always interesting about Houston, and whenever I go to a lot of conferences, they compare obviously the major metros in Texas, and even when the number of jobs in Houston doesn't increase as much as Dallas, we will still see people move into Houston. So like that population growth number of like 100,000 people every year seems to continue to go on and on and on and happen. So that 1.5% increase that you're seeing in Houston and even Dallas Fort Worth, I think even though we're going to see a pause in the number of jobs that happen or increase in that market, people are still moving here. So I think that's going to bode well. Obviously, we want people to move to Dallas and move to Houston who have jobs to pay rent, but eventually those people will get jobs and will pay rent, and hopefully they're just not living with their parents in the basement. So let's talk about the apartment market, sort of what's going on sales right now in Houston.
Yeah, so I mean, obviously due to COVID, when we were in the peak of transactions in Q3 2018, we had a sales volume of almost $2 billion. But when we look at transaction volume in Q1 2020, due to COVID, it dropped 83% to 326 million of sales transaction volumes in Houston. And so that's kind of been the biggest thing of the fallout. Not a lot of deals are being out there in the market as we've seen. Price per unit has gone up modestly. The U.S. price per unit has gone up modestly, but the house price per unit for Houston, multifamily price per unit is relatively the same. So, decrease in transaction volume, but the price is very similar. Or appraisals actually have gone up because of low interest rates.
So the green line here is the national, and they're sort of predicting sort of about the same for Houston in terms of a dip sort of for 2020. And so I guess they're not for that dip is the forecast in price per unit in the blue line.
Yeah, yeah,
Okay.
yeah, it
All
is.
right.
I mean, I think they're predicting the that U-shape recovery.
Okay.
I'm assuming, but we don't know if it's a U-shape, V-shape. It's all up in the air right now.
Okay. All right. So let's talk about cap rates.
Yeah, so I mean, I think if we look back, early 2012 or 2011, there was a wider spread of the cap rates versus your A class and C class. As we have gone into now, everything has compressed, and so you're not getting the same returns for your C class value add versus your A class. And so now, what I have seen, just from the research that I've read, is a lot of institutions are offloading their C class properties and looking more towards the 2000 or newer B class builds because they don't have to put the additional capex spend into it, and they're getting a lot more closer cap rates versus your C class value add so far in Q1 2020.
So this is CoStar. They're predicting an expansion of cap rates by close to, I don't know, 75 basis points, maybe 100 basis points over the next year, and then has it come back down. So I guess most people, I guess as long as you don't sell in 2021, I think you're okay, I guess, per this. If the cap rates, because it looks like it expands but then it comes back down, I guess once the economy sort of gets unemployment under control and everything gets back to normal, they're expecting it to come back. So it's just almost like the flip of the other chart in terms of price per unit. This is your cap rates coming up about 75 basis points to 100 basis points, then coming back down. I guess let's go into maybe Houston more specifically, talk about the submarkets in Houston and what you're seeing in those markets.
Yeah, so I mean, I think like I mentioned in the earlier slides that there's a lot of demand still in Houston, and so the supply hasn't kept up with it. But when we look at from the past 5 years, 10 years, or in Houston, downtown Houston is where you've seen the most largest supply growth of multifamily apartments, at 49%, versus your northeast side of Houston, where it's been very stagnant, especially in the Baytown area. Then we also seen the highest growth in rents in the Houston metro area overall. So downtown Houston inside the loop, a 610 loop, has been the hottest market for multifamily compared to all the other submarkets around. But I think one thing I think is very interesting to think about is with people working from home now, are they going to be more inclined to just stay put or live outside the loop instead of making that drive all the way into, so they don't feel the incentive to pay the higher rents inside the loop? Maybe they'll live in Sugarland or Cypress or Katy, and where it's a little bit cheaper. And we could see a rent growth in those submarkets.
Is there in Dallas, you can sort of look at the rings around downtown and it's sort of like, the 60s stuff was built here. You go a little further out, it's 70s and in 80s and in 90s and in 2000s, sort of like where I'm up in sort of North Dallas, Frisco, that's all sort of 2000s and 2010 construction. Is it similar in Houston? Is there like a couple submarkets that sort of, if someone's looking for B and C product, where's that located in Houston, and sort of how are the rents there? How's the sales in that submarket?
Yeah. So, I mean, just from my knowledge, that the research I have done so far, when you're looking at like 45 South, you'll get a lot of your C class older apartments, your 70s build, or your B class 80s build, and so your C class that I think I did a report the other day is 45 South area, it's around 65 a door, or general population of Houston for B class 80s build is going around in the South area for 75 a door. But then if you go to the north, like kind of the east side, west side of Houston, your C class apartments kind of go up from 65 a door from the south side to more 85 a door over there. So it's like you said, certain regions, submarkets in Houston are a little bit more. Then if you obviously go to the Woodlands, I don't know if I even consider that Houston. I'm not sure the price per door there, but it's obviously similar to inside the loop of downtown.
Okay, so let's jump into some of the sales that have happened. Obviously, all these either got out in contract sort of pre-COVID, or maybe just when COVID started. So let's talk about the sales and sort of give people an idea of where these occurred.
Yeah, so I mean, like I said, if we think about Q3 2018 having a high transaction volume, now we think about the past 3 months, April, May, June. These are the 11 deals that were sold in the Houston markets. So a lot of them kind of outside the loop, 610 loop, southwest side, and so not a whole lot, but it's inside the Beltway 8, so that's something we're kind of seeing as well. But these were the 11 properties that were sold. The one major one that kind of made headlines was the loft at Ballpark. That was bought by an LA firm.
So it looks like the green ones are more your Class A stuff. So that's sort of inside,
right.
610, newer construction. And then as you move sort of to the blues, that's sort of your B stuff, maybe A minus B stuff. And then your C, Class C stuff is more sort of further out as well. So let's jump in and sort of give some specifics around sort of price per door for these properties.
Yeah, so I mean, if you look at the A class stuff, like I mentioned, Lost at Ballpark, that was 158 a door. I know, and then the other ones were 164, 145, and I know James, you're saying like you couldn't buy that. What was the price per unit for an A class in Dallas? You were mentioning.
Yeah, I mean, like if you look at, let's say you go down to a 2015 build, right? There's no way in Dallas, it'd be pretty hard to buy a 2015 build for 137 a door, right? So, I think Houston is probably, let's say 10% lower, probably on a price per unit. And I don't know if people are just getting that because they're getting a slightly higher cap rate for being in Houston, or the expenses are just a little bit higher, and so that's driving down the price per door. But you're probably, because that deal that they bought, it's probably trade for 150 to 155 a door here in Dallas in a similar submarket. And so I think you are getting a little bit of a discount in Houston right now.
Mm-hmm.
Anything on the A stuff was sort of 157 to 200 a door, and then sort of your B minus stuff that's probably, the 1982 stuff was trading around 60 to 70 a door.
Yeah. The
Yeah,
C class properties I mentioned, it was like 60, 65 a door. I've been seeing, um, and then yeah,
yeah. And it looks like a majority of the B and C stuff was sort of bought by individuals too, and sort of your upper stuff is being bought by either real estate investment trust or larger sort of private equity groups.
yeah. Kind of how I mentioned the cap rates were compressing, so a lot of these groups were offloading on their C class properties, and you'll see. I started seeing a lot of first time investors or guys or girls are looking to grow their portfolio um, um, with specific C class deals. So it's kind of what I've been seeing.
Okay. And I guess you wanted to wrap up with some lessons learned maybe from 1989. Anything
Yeah.
here that you wanted to mention to everybody?
Yes, I mean, I think a lot of people saw this email chain that was sent out just for lessons learned from the 1989 Southwest real estate crash. You know, a lot of the owners I'm talking to, they're saying no more often to deals. That was one advice. But I think the main thing that I wanted to focus was on with COVID happening, owners may be wanting to collect rents or bad debt might start rising. How are they going to react when they want to evict them, but the tenants have a reason not to be evicted? And so one quote that stood out to me was, "Juries are sympathetic to tenants." And once we start seeing possible evictions happening and they go into court, how is this all going to play out with the housing laws and everything? So that was one thing that really stood out to me is are they going to be the juries, like I said, are always more sympathetic to the tenants, and so it's going to be even more relevant now, I think, in 2020 than 1989.
Yeah, I mean, around the CARES Act, I think you couldn't evict, and that was one of the biggest concerns. But as we saw, in the collection slide, people are still paying rent because when you tell them to stay at home, they pay the rent because that's where they want to live,
Yeah.
and that's where they have to stay. So it's funny how that happens. So it just yeah, well, it'll be interesting to see sort of once the CARES Act sort of goes away and or sort of expires and evictions come back and counties start opening back up, then we'll just have to see sort of how that eviction plays out within tenants. So I guess to wrap up, Zach, maybe give us just a little bit about sort of what you do and sort of what people can reach out to you for to get more information on.
Yeah. Like I'm new to my real estate career. I'm very excited, and I've been learning so much. And I kind of just focus on Houston, yeah, because that's where I was born and raised. And so, I just been enjoying reaching out to owners and investors. What are they looking to do with their deals? A lot of them right now are kind of staying put, staying patient. One thing that I have seen is, your one-off owners who might be living out of state. It might be too difficult, especially during these times, to manage that out of state. So that's where I've seen a lot of opening. Or your one-off owners who are, self-managing the deal, especially during now. It's pretty difficult. So those are a lot of the people I've been, working with, and so learning a lot every day. And if you have any questions on how I can help and or what I'm seeing in Houston, I'm happy to share the knowledge that I've done and the research I've done. But yeah, more than anything, thank you, James, for having me on and just kind of giving you a high level overview of what I see in Houston. And so thank you.
All right. Thanks a lot, Zach.
All right.